Hello there, so in today's video I'll be talking about Realty Income Corporation. I'll go through exactly what it does, we'll go through the finances, I'll go over the share price, and then I'll let you know if I'm buying, selling or holding the stock and at what price for. If you're new to this channel, welcome. My name's Andy and on this channel I like to talk about money and success. If you're interested in making, saving or investing money, please be sure to hit that subscribe button down below, hit the notification bell and then you get notified every time I release a new video. And if you find this useful, please do remember to hit the thumbs up because that helps YouTube algorithm, which in turn helps me and I really do appreciate it. So if you've watched this channel before, you've probably already know that I have shares in Realty Income Corporation. At the end of this video, I'll let you know how much I paid for those and likewise how much I would be looking to pay if I was to buy more of those shares. So that will be covered at the end of the video. If you don't know what Realty Income Corporation is, don't worry. That's what I'm going to go through with you right now. So here's their website. First thing you notice at the top there, their logo, Realty Income, and underneath you'll see they've trademarked the term the Monthly Dividend Company. That's right, there's a clue right there in the name. They pay dividends monthly. Now if you're interested in monthly dividends, I made a video just recently showing all of the monthly dividend companies that are available. Every company that pays monthly dividends I put into a list into one video. If you're interested in that, I'll put a link up there and in the description down below. So if you are interested in that, go and check that out if you're particularly looking for monthly dividend companies, but this is obviously one of them. So as you can see here, monthly dividends, strong shareholder returns, 15.3% compound annual total return since 1994, which is obviously very good indeed. You've got 4.4% compound annualized dividend. They've paid 612 monthly dividends, that's consecutive monthly dividends at that, and they currently have a real estate portfolio of over 6,600 properties under long-term net lease agreements. So this is from their latest investor presentation, and you can see here how Realty Income compare in the middle column compared to say shopping centres and malls. I just want to quickly jump in here. If you're not aware what a REIT is, I'll put a link in the description down below. I have made a video about that, but basically they have to pay out a percentage of their profit as dividends. They have to by law. So they're essentially a landlord. They buy properties, they rent the properties out, they take income via rent. The difference between the rent and the mortgage is the profit, and then they pay that profit out or a big portion of that profit out to shareholders, and that's basically what they do. So what we're looking at here is how Realty Income compare to shopping centres and malls in terms of as being a REIT. You'll notice their initial length of lease is 15 years plus versus 10 years. The longer the better. The remaining average term 9 years versus 5 to 7. Again, obviously that's better. Responsibility for property expenses. For Realty Income, you'll see it's the client, whereas often in shopping centres and malls it's the landlord, which in that case would be Realty Income. Now the key point there is Realty Income have low expenses because they do what's called a triple net lease agreement, and that is a fantastic thing because it basically means that the tenant is responsible for all of the repairs and maintenance. So if you imagine if you could have a triple net lease and you owned a house and you rent that house to someone, if something goes wrong with it, the roof blows off, the tenant would be responsible for fixing that roof. And that's basically the deal that Realty Income Corporation have. So when they rent it out to people, the companies they rent it out to are responsible for looking after everything to do with that property. So there's very little costs in terms of upkeep for Realty Income. So hopefully that clears up that. Gross margin 98% plus versus 75%. Volatility in rental market low. Maintenance capital expenditures low. And so on, the list goes on as you can see there. So obviously compared to shopping centres, it trounces them. So now let's have a little look at what would happen if interest rates increased, because that's one of the common concerns. You think, well, if I'm investing in real estate, if interest rates go up, then the cost of the mortgages are going to go up. And if the cost of the mortgages go up, obviously that's going to reduce the profit margin for the landlord, which in this case would be Realty Income Corporation. So they've explained what would happen here. And as you can see, it takes 12 months for the cap rates to adjust to changing interest rates. But if you look at that graph at the top there, you can see that basically the profit margin essentially stays the same. So it's not actually something that you need to worry too much about, because what generally happens is if interest rates go up, rents go up as well. And that's just the way the world works. And yes, there is a lag, so there'll be a delay in it, but it will go up. and that will essentially protect the profit margin. Fortress balance sheet, one of only 8 US REITs with 2 A3, A- ratings or better, as you can see there. And I'm going to review the balance sheet a little bit later, so you'll see exactly how the balance sheet looks. Diversified, high quality portfolio. Now this is a very important slide. If you look on the left hand side there, you can see the diversification of their top 20 clients. So you can see their biggest client is Walgreens, which is obviously massive company, but it's only taken up 5.5% of Realty Income's entire portfolio. Its second biggest client there, 7-Eleven, takes up 4.6%, then Dollar General, then FedEx, and so on down the list. And eventually you get Sainsbury's, which is massive over here in the UK, and then Tesco's takes up 1.4%, which again is massive over here in the UK. So these are all big companies. Now, if you look the weaker companies, if you like, the ones that probably didn't fare so well in the pandemic, you've got AMC Theatres. If you've been following the stock market at all, you will have known all what went on with those. You would potentially say the fitness companies, so LA Fitness, maybe Lifetime Fitness, because those were the companies that were forcibly made to close during the pandemic. So you're thinking, wow, they could have hurt this company. But look what a tiny percentage of Realty Income's overall portfolio those companies actually make up, which is how come that actually during 2020, Realty Income didn't just maintain its monthly dividend, it actually increased it. Not once, not twice, but I think it was 3 times actually. We'll check that a little bit later when we look at the dividends. So the point is, it's a very well diversified company. Top right, that graph there, it shows you broke down by sector. I won't read you through that. And then you can obviously see its biggest states, if you like, and then it's got the UK in there, which is obviously highlighted because it's not a state. The UK is obviously a country, which is where I'm from, and that makes up 7.2%. So they've got a little bit of international there. Diligent underwriting process results in minimum exposure to retail bankruptcies. You'll see at the bottom there, this is page 38. Basically, there's like nearly 50 pages in the investor presentation. I've just pulled out the ones that I thought were important to you. I will put a link to the full investor presentation in the description down below. So if you are interested in having a read through that, you can. All I've done in this video is I've pulled out what I think are the important points so that I can give you an overview, point out the important points to you, because the whole idea, I think, of watching a video like this is to save you time so you can just get the nuts and bolts and the key points across. So this was one of the slides I thought was key important, and that's why I'm going through it now. And I'm only going to go through 8 slides. Don't worry, like I say, I'm not reading every slide to you. So what this really shows you, on the left-hand side there, it shows you the total retailer bankruptcies since 2017. Okay, so that's including in the recent pandemic, but since 2017, which is obviously 3 years prior to the pandemic as well as. And you can see in the apparel sector, 34. And then on the right hand side, it tells you what kind of exposure Realty Income Corporation has to each sector, if you like. So I'm not going to read every single one to you because I think that would just be silly, but I will just, point out the key points for you. So you can see in the apparel sector, it's limited. Casual dining, again, they actually had 97% of rent through the duration of the pandemic, so they did very well on that, which is a sector which was forcibly made to close. You would expect it to do bad, yet they got 97% of the rent, so that just shows how well they vet their tenants, essentially. Specialty retailer, they've got limited exposure to that anyway. General merchandise, exposure to clients selling non-discretionary or low-priced goods. Well, those kind of stores always do well. Grocery, immaterial exposure to bankruptcies. Basically, they didn't have any bankruptcies there. And in the UK, they've got Sainsbury's and Tesco's, which are absolutely huge here and unlikely to go bankrupt. And actually, when I was researching UK stocks and shares, Tesco's was actually my favourite supermarket stock, I'll be honest with you there. Anyway, let's carry on. Health and fitness, as you know, they've got 2. So 2 top clients are large national operators with strong scale and access to capital, one of which paid 100% of its rent through the duration of the pandemic, which means one of them didn't pay all of its rent through the pandemic. And I'll note they haven't said how much was or was not paid. So we don't know how badly the other one did. And you can obviously come back to this slide and read the rest of that at your leisure. So just pause it there if you would like to do that. Stable and predictable cash flow supported by a high quality real estate portfolio. Now, this is an interesting little graph, I thought. It really shows you how Realty Income Corporation is doing in comparison to the S&P 500 REIT medium. So that's kind of like the average REIT in the S&P 500, if you like. And you can see what they're basically saying is Realty Income Corporation is far outperforming them. And all you really need to look at on this page are the 2 dotted lines. The dotted line that says 98.2%, that's Realty Income's medium. And the dotted line that's got next to 94%, that is the S&P 500 REIT medium. So that's how it essentially is comparing to the average of its peers. So what they're saying here is it's above average. So it wouldn't be fair to be doing a review of Realty Income Corporation without mentioning the upcoming merger, and this slide here explains their rationale behind the merger, and it's with VEREIT, and they will basically be benefiting from economies of scale. Again, you can pause this slide and read all the benefits, but I've summed it up there. I think it's the economies of scale that they're going to benefit from. And again, this is the other slide that really goes on about that particular merger. And the key point you're looking at here on this slide is they're going to get synergies of scale, which means they're going to be able to reduce their borrowing costs. And if they can reduce their borrowing costs, that obviously increases their profits. Now, I'm going to just show you quickly a little bit about VEREIT, so you know a little bit about them as well, seeing as the two companies are essentially merging. So here is VEREIT's website. And you can see they claim to have a high quality, diverse portfolio. You can see the breakdown there, 46.6% retail, 20.5% restaurants, 17.9% industrial and 14.9% office. You can see it's got good tenant diversity with 62% of tenants being non-investment grade and 38% investment grade. So they're not quite as investment grade as Realty Incomes. I know I didn't show you that slide, but I did research it fully before making this video, so I can tell you that Realty Income Corporation have a very high percentage of tenants that are investment grade. Occupancy 98%, that by the way is the same as Realty Income Corporation. And geography diversification, as you can see, they're spread across 49 states. And then I'm just scrolling through the states here so you can see what states they are spread across. So one thing I will just point out here is they have 3,855 properties with a market capitalization of 14.5 billion. So when you add that together with Realty Income Corporation, you're going to be looking at over 10,000 properties, and Realty Income Corporation's current market cap is about 28 billion. So this is just over half as big as Realty Income Corporation. So it will be essentially a 50% increase in size to Realty Income Corporation once the merger goes through. But for now, let's focus on Realty Income's finances. Let's take a look at them right now. So starting off with the balance sheet, the first thing I like to look at with the REIT here is the total real estate assets. You can see back in December 2011, it was basically 4.1 billion because these figures are in millions. And by the last report, that had gone all the way up to 18 billion. So over the course of 10 years, it has more than quadrupled. The next thing I like to look at are the total assets. So you can see that the total assets in 2011, 4.4 billion. And in the latest report, that had almost multiplied by 5 to 4.9 billion. And the total liabilities, you can see there at the bottom, they started off at 2 billion and they're now at 9.4 billion. So they've gone up by a comparable amount, slightly less actually. So that's actually a good thing. Their ratio has been improving, and I will actually go through the ratio a little bit later because assets to liabilities ratios is something I'm big on. So I will go through that a little bit later with you in the video as well. Now let's take a look at the income statement. So the first thing I like to look at is the total revenues. And again, look at the trend there. It's been climbing. So it was 412 million back in 2011, and it's just basically grown year on year on year. And in the latest trailing 12 months, it's 1.6 billion. Which is not too bad at all. So the next thing I like to look at is net income, and you can see the net income there. Back in 2011, 157 million, and it's more than doubled in the current trailing 12 months. It has actually dipped a little bit. If you look, 2019 was the best year. It was very high then, and it has fallen back a bit since then, but that's kind of to be expected given the pandemic. But that does show that they were affected by that. But you also have to bear in mind the net income could be affected by expansion as well. When they buy new assets, new real estate, that can bring the net income down as well. So next, let's take a look at the share price. You can see over the previous 12 months, it has risen 16.9%. It's gone up and down and up and down and up and down. Now, one of the slides that I actually deliberately missed out from the presentation was one that says it's very smooth and it never has any dips. Look at this share chart here. I think to say it never has any dips is not fair. If you look in June, it was $71. Now it's currently trading at $70 again. It dipped down all the way down to $67, $66. Just a month earlier than that, it was $59. If we look at the 5-year average chart, you can see again, in 2016, it was up at $72. And by 2018, it had fallen down to $48. So this is up and down. Okay, the general trend is up, and obviously everything dipped, in March 2020. That was the big crash. And you can see very clearly it hasn't fully recovered yet. It's currently sitting at $70. So if you're someone who believes it's going to make it back to this very peak there anytime soon, then there is room for growth there because that was $82. But bear in mind, in the year of 2019, this is the year it was making its biggest profit. So 2019, while it was around this kind of price, look, $69 to $73 share price, that was the year when it had its highest revenue year in terms of net income, which we've just looked at there. Then the net income dipped and presumably the results from the net income came out, and that's what's probably caused this rise here. Then it pulled back slightly and then rose again before crashing like everything else, and it has obviously recovered since then. And if we look at the overall long term, then you have got a very nice upwards trend. And yes, with the long term, the ups and downs become very much less noticeable, as you can see there. They are very much less noticeable, but there's still spikes. You know, there was high relative to here, so it is up and down. At the moment, it's lower than its highest it's been. I'm sure if you were to buy now over the long run, you're going to be fine. But is it a good price to buy at? Well, we're going to cover that a little bit later. The dividend yield there, as you can see, is 4.2%. The price to FFO is 20.73, which is fairly high for a REIT. If you don't know what price to FFO is, it's probably worth you watching one of my versus videos. I've done lots of versus videos, and some of those are REITs versus REITs. In fact, I've done a versus REIT for Realty Income. So I did Realty Income Corporation versus Federal Realty Corporation. I'll put a link up there and in the description down below to that if you are interested in looking at that. But in my REIT videos, I always talk about this, and you can see, but basically the lower the number the better. That's the gist of this. So now let's take a little look at the dividends for this company. Let's have a look at them now. So dividend safety, you can see at the top there, this is Seeking Alpha's giving it a C- for dividend safety. The dividend growth is a B, the dividend yield is a B-, and the dividend consistency is an A+. It would be unfair if they'd given anything less than an A+ for the dividend consistency. We'll look at the history of dividends in a moment. You can see the dividend yield is currently 4.02%. The annual payout is $2.83 per share. Bear in mind that's paid monthly. The payout ratio is 83.45%, which is actually very low for a REIT, so you can expect a dividend increase soon. The 5-year growth rate has been 3.72%, and its dividend growth has happened for the past 24 consecutive years. It has had growing dividends. Let's have a look now at the dividend history. If I just click this onto maximum, you can see what a thing of beauty this chart is. It's just been growing and growing and growing and growing and growing non-stop, basically forever. And it's monthly. And if we go down here, I want to show you here, you can see the dividends in 2020 started off at 23.25 cents per share. They then increased to 23.3 cents per share. They then increased again, and then increased again, and then increased again. So how many increases is that? That's 1, 2, 3, 4 increases in 2020. Bear in mind what happened in 2020. They increased their dividend 4 times. And if we was to go back and I show you back any of the previous years, you'll see this is a normal thing, look. So increase 1, 2, 3, and 4. Previous year, increase 1, 2, 3, and 4. Year before that, they increase it 1, 2, 3, 4. You get the picture. Basically, every quarter, Realty Income increase their dividend. Now, admittedly, they're only increasing it a tiny little amount each time, but the point is it's continually growing, which is one of the things that makes this such a popular investment with people who are retired, because they know they're going to get a regular monthly income and they know they're going to get a pay rise 4 times a year, which obviously is quite a nice little touch. Admittedly, at the current yield, 4%, that's not massive, but it beats the stock market. It's way higher than the stock market average, so it's still a fairly good yield. Personally, I would like a little bit higher, and later in the video I'll show you exactly what price I will be buying at and what yield I will be aiming for, but that's a little bit later on. But the point is, it is continually increasing, so that is a good thing. So next, let's take a look at the assets versus liabilities. If you've seen any of my versus videos or any of my previous stock reviews, you will know I put a lot of weighting onto this particular metric. I think it's very important. I only like to invest in companies with good balance sheets. The reason for that is fairly simple. It's because a company with a good balance sheet is very unlikely to go out of business, therefore my investment is safe. If you would like to see such a video, I'll put a link up there and a description down below to my versus videos playlist, and you can click and have a little look through some of those videos and see. I've also reviewed Stag Industrial, for example, which is another monthly dividend stock, so if you're interested in that particular stock, feel free to check that out. Again, I'll put a link up there and a description down below to that one. Again, that is a REIT, but unlike Realty Income Corporation, that is a REIT that invests in warehouses. So its biggest tenant is Amazon, for example. So it's done very well in the recession, and it's a very popular investment for people who want a monthly income. So anyway, let's have a look at this metric. So total assets versus liabilities. You can see the total assets there, basically 20.9 billion. The total liabilities, 9.4 billion. which gives an asset to liabilities ratio of 2.23. That is absolutely phenomenal. Let me just get that out there now. When you're looking at a company, you really want it to be over 1. If it's over 2, it's exceptionally good. This is over 2. This is exceptionally good. Happy, big thumbs up. Current assets to current liabilities, you can see the number there. Current assets to current liabilities, 2.93. That's almost a 3. Again, absolutely phenomenal. I don't mind the current assets to liabilities being a bit lower. I like it to be above 1. If it's below 1, I think that's a bit of a red flag. But to be almost 3 is fantastic. So that's really good. This has got a very healthy balance sheet at this exact point in time. So now let's go through how much I pay for the stock, how much I would pay if I was going to invest more into the stock, and why. Let me go through that with you now. So I bought into Realty Income Corporation when it was $60.12. The current market price is $70.29. My new target buy price would be $62.89, so $62.89. That would get you a 4.5% dividend yield. And I'll be honest, I'm saying that's my target buy price. If it does go to that price, I'm not guaranteeing I'm going to buy at that price. I would consider anything under $63. My ideal buy price would be $56.60. If it went down to $56.60, then yes, I would almost certainly be investing in this stock because I would be getting a 5% dividend yield. And I think that's good given the growth that this company has in terms of its ongoing monthly dividends that do keep growing forever and ever and ever, it would appear. Thank you so much for watching. I really hope you've enjoyed this video and found it useful. Please do leave me a comment down below. Other than that, thanks for watching and bye-bye.